Today's financial market update, the most important market insights you need to know. Market sentiment is bearish, mild. Market is declining across major indices. Index performance, S&P 500 at minus 0.18%, Dow Jones at minus 0.03%, NASDAQ at plus 0.0%, Russell 2000 at minus 0.09%. The stock market currently exhibits a bullish phase, fueled by macroeconomic optimism despite existing geopolitical tensions. The bullish sentiment suggests that investors are optimistic about economic growth, but caution is warranted due to potential external shocks. Focus on sectors that may benefit from lower oil prices, such as consumer discretionary, while remaining cautious of energy-related investments. U.S. oil prices have surged past $100 a barrel due to escalating geopolitical tensions in the Middle East. The surge in oil prices typically leads to increased costs for consumers, which can dampen spending and economic growth. Consider diversifying portfolios with energy stocks or ETFs that can benefit from rising oil prices and heightened demand. Sixth Street Specialty Lending TSLX reported robust Q4 2025 earnings, with VP Alan Waxman investing $553 million in 300K shares. The strong earnings from TSLX and BBIO signal resilience in the lending and biotech sectors, showcasing investor confidence in these industries. Investors should consider increasing exposure to biotech firms like Bridge Biopharma, capitalizing on their significant revenue growth and favorable analyst ratings. Consumer confidence is declining as investors react to rising oil prices and increasing recession fears in the market. The drop in consumer confidence signals a potential slowdown in spending, which may lead to decreased earnings for various sectors. Consider defensive stocks in sectors like utilities and consumer staples, as they tend to perform better during economic downturns. The effective federal funds rate is projected to decrease from 4.33% in March 2025 to 3.64% by February 2026. A decreasing funds rate typically leads to lower borrowing costs, encouraging both consumer spending and business investments in the economy. Consider increasing allocations in sectors poised for growth, such as consumer discretionary and financials, which benefit from lower interest rates. The U.S. GDP growth rate is projected to slow to 1.5% in the next quarter, indicating economic cooling. Slower GDP growth signals a potential downturn, prompting investors to reassess their risk exposure and portfolio allocations. Focus on defensive sectors such as utilities and consumer staples, which typically perform better during economic slowdowns and heightened uncertainty. Oil prices have surged past $100, driven by heightened tensions in the Middle East affecting global supply. The rise in oil prices signals increased geopolitical risk, which may lead to inflationary pressures across multiple sectors for investors. Consider investing in energy sector ETFs that focus on companies with strong fundamentals, as they may benefit from rising oil prices. U.S. oil prices have dipped below $90 a barrel, reflecting shifting supply and demand dynamics. The decline in oil prices could indicate easing inflation pressures, but it also reflects concerns over global economic growth. Consider investing in energy stocks that could benefit from a rebound in oil prices if geopolitical tensions escalate. Crude oil prices have surged by over 15% in the past month due to escalating tensions in the Middle East. Rising oil prices typically signal increased production costs, which can pressure corporate profit margins and lead to lower stock valuations across various sectors. Consider diversifying into energy stocks or ETFs that may benefit from rising oil prices, such as those focused on exploration and production. Oil prices have surged past $100 per barrel, driven by escalating tensions in the Iran conflict. The rise in oil prices indicates a market reaction to geopolitical instability, signaling increased risk for energy investments. Consider diversifying into energy stocks that have strong fundamentals and can withstand market volatility. China is prioritizing economic stability and international cooperation as global economic conditions remain uncertain and volatile. The emphasis on stability from China signals potential resilience in its economy, which could provide investment opportunities for risk-averse investors. Investors should consider diversifying portfolios to include stocks in sectors that may benefit from China's focus on stability and cooperation. EQT has initiated a cash tender offer to repurchase up to $1.1 billion of its senior notes. EQT's repurchase indicates a strategic move to enhance liquidity and reduce interest burden during uncertain economic times. Consider allocating funds into refinanced debt offerings like Amcor's, as they can provide stability in uncertain environments. JP Morgan reduced Alexandria Real Estate's price target from $63 to $57 while maintaining a neutral rating. The price target reduction by JP Morgan indicates growing investor caution, reflecting concerns about Alexandria's financial stability and market position. Investors should consider a cautious approach to Alexandria, weighing the risks of declining profitability against insider buying as a potential positive signal. Geopolitical tensions have led to a 15% decline in investor confidence in private equity markets this quarter. The decline in investor confidence suggests a cautious approach, leading to potential volatility in private equity valuations moving forward. Focus on sectors with strong fundamentals that remain undervalued, as they could present attractive long-term investment opportunities. Oracle Corp achieved $4.9 billion in cloud revenue, marking an impressive 84% year-over-year increase fueled by AI bookings. Oracle's substantial cloud revenue growth indicates a robust demand for AI-driven solutions, signaling a favorable investment climate in technology sectors. Consider investing in Oracle to capitalize on its leading position in AI-driven cloud services, as demand is expected to continue rising. Bitcoin ETF flows have declined to $690 million, indicating a shift in investor interest amid market turbulence. The drop in Bitcoin ETF flows suggests that investors are becoming more cautious, potentially reallocating funds to safer assets. Consider diversifying portfolios by incorporating less volatile assets to hedge against the current market uncertainties affecting digital assets. U.S. oil prices have recently dipped below $90 a barrel, impacting the broader energy market landscape. The decline in oil prices signals a shift in market dynamics, suggesting potential short-term volatility in energy investments for cautious investors. Consider diversifying into renewable energy stocks, as lower oil prices may drive increased demand for sustainable alternatives in the long run. Thank you for watching FERPA, your financial Sherpa.